Rules. Afterwards. Question number 11 for Mr. Rich buys a flat, pays 5 crore cost and 5 lakhs of rupees.
Can I take up?
Yeah, sure.
Yeah, sorry, it will save time. There are 4 issues in this. This is surrounding the society. A person is acquiring a flat. He pays, 5 lakhs rupees by way of transfer fees or some kind of a donation to society. And the issues which arises are, the issue number 1 is that whether that amount which has been paid to the society, would it form the part of cost of acquisition for him? Can he therefore claim a deduction in computing section 44 benefit or not? That is one first part. We have by now a reasonable position, as we have seen in the cost of acquisition qua the interest is any expenditure which is necessary for the purposes of acquiring a better title or putting the asset in a place where it is presently available, then in that case that expenditure will be loaded to the cost of acquisition, and this is by and large should be a reasonable understanding. As far as the other aspect is, what is the nature of this receipt in the hands of the society? Will it be taxable? Will it make any difference if it is received by way of a donation, or is it received by way of a transfer fee, or it is received by way of a contribution to some kind of a fund, repair fund or such other thing? I would believe that yes, that irrespective of the nature of payment, as far as receipt is concerned, in the hands of the society, it is from an incoming member. And for quite some time, we had those 2 issues, that whether a receipt from an incoming member will face the test of or satisfy the test of mutuality in the hands of the society. And what happens if the transfer fees are in excess of what has been permissible to be received under the Maharashtra Cooperative Housing Societies Act or any other Societies Act of the relevant states. It appears that consistently the courts are taking a view that irrespective of whether the receipt is from an incoming member or an outgoing member, the test of mutuality stands satisfied. And that whether the receipt was on account of transfer fees or on account of a contribution to fund, unless the department demonstrates that it was in the nature of an income, the test of mutuality would stand satisfied. And Bombay High Court has been consistently taking that view. The third aspect is that the society also is in receipt of interest income, one from State Bank of India and the other one is from some other cooperative bank where the funds which belong to the society were parked. Here we have a Supreme Court decision and a Bombay High Court decision clearly holding that as far as the interest income of the society is concerned, irrespective of the fact that it is being received from one of the members of the society, a corporate member or such other case, it will not satisfy the test of mutuality. And Supreme Court has nicely explained, so has Bombay High Court, but Supreme Court has in detail explained that why it does not satisfy the test of mutuality. I will request you to please look into that. But important thing is, to Supreme Court it is a separate scheme of income and there is not a complete identification between the participants and the contributors. And in that view of the matter, it has a commercial theme, and because of that it should be taxed in the hands of the society. This appears to be a settled position. The last issue is that whether a society can claim a standard deduction of 50,000 in relation to ATP 2C2. I would take a call that it would be an incorrect claim for the reason that ATP 2C2 grants a deduction in respect of an activity income. If an income can be attributed to the activity of a society, and putting money in the bank is not a main activity of the society, and therefore you are not entitled to a housing society. If other activity societies would be entitled to it in respect of that income. I would rather invite your attention to clause D, which grants a straight deduction in respect of dividend and interest, irrespective of the quantum of the receipt. So it is that clause which should enable you to claim the deduction.
So under 80P2D, the interest received by cooperative society
Yes,
from
should be,
cooperative bank
because
should be.
it doesn't come with a caveat that it should be an activity oriented
Department
income.
is disallowed.
Yes. Yeah. Yeah. Next.
Yeah. Mr. Jagmohan, should I be?
I'll take it. Yes. Now this is a very interesting question. I don't know, why, we have ignored this, issue with its multiple facets. So we will try to address to the extent what is possible, and with all limitations. The issue is fundamentally a basis in the Maharashtra Rent Act of 1999, wherein till 1999 you were not permitted to receive any pagdi if you were a landlord. Till 99 you were not permitted if you were a tenant to transfer the tenancy rights for a consideration. The present position under 1999 law is somewhat like this, that a landlord is allowed to receive pagri, in a loose sense I am saying, which is commonly known in legal parlance as salami or a premium. So a landlord is allowed to receive a consideration on creating a tenancy. A tenant is allowed to pay a consideration for the purposes of acquiring tenancy. A tenant is allowed to transfer the tenancy rights for a consideration from a rank outsider who would want to be an incoming tenant. This is generally the law. But important thing in the law is that whenever the tenant transfers the tenancy right, usually it will have to be with the consent or a consideration of the landlord. So in this background we will have to examine that what would be the case when a landlord creates a tenancy on receipt of a consideration. Would there be a transfer? Has landlord transferred any capital asset which is otherwise, or is there a need to have transferred an absolute capital asset or not a right in a capital asset? To cut the issue short is that there is a settled position is that a property that is an immovable property is a bundle of right. Each right is capable of being sold for a consideration separately, and each of such would be considered to be a transfer. So if that is the position, whatever landlord has received for creating the tenancy, he has parted with a bundle of right in respect of a capital asset which is the premises. And on transferring or creating or transferring the right for a consideration by virtue of section 55, whether now where tenancy rights has otherwise been considered to be a capital asset, which it was always so, but there was no cost of acquisition, section 55 with effect from 1995 has cured that defect. So you have this series of decisions which is holding that a salami or a premium received by the landlord is taxable. Then other important story is about if it is taxable under which head of income it is taxable. And here there is a conflict of views. Is it taxable under the head income from house property? Now apparently you would be, really blushing that, what exactly is being asked. Can it ever be any other income other than the capital? Once we are admitting that some right in a property is being transferred. But again, the revenue also this time has come out with a beautiful contention. And the contention is that is it not taxable under the head income from house property? And the counter of the assessee was, how could it ever be taxed as income from house property? And that was the reply that it is nothing but a rent paid in advance. So if it is rent, it surely is taxable under the head income from house property. This is the issue which is arising. We have some decisions which have been examined, which had the occasion to examine the liability under TDS, on payment of a premium, and also in the context of what we are discussing. By and large, it appears to me that yes, that these decisions are canvassing a view whereunder something which is not otherwise in the nature of rent, and wherein the department has not established that it is in the nature of rent, What you are parting with in respect of not licenses of short-term nature, but the tenancies of a long-term duration. And if you are parting with the possession, then in such cases, it would be considered as a income in the hand, income which is of a capital receipt, taxable under the head capital gains. The Supreme Court decision has in detail examined that what would be considered as an advance rate and what would be considered as a salami or a premium. The third issue is that will J, who is the landlord, be allowed to claim it as an expenditure? If he has incurred some expenditure which is linked to transfer of the right, surely he is welcome to claim all the deductions which could be classified as an expenditure relating to transfer under section 4. This is something which has created some heartburn. Here is a case wherein the landlord, instead of creating a tenancy, allows the outgoing tenant to transfer it. Allows the outgoing tenant to transfer it to a new person, incoming tenant. And the landlord chooses to confirm and bless the transaction. And for the purposes of this blessing, he receives a consideration of 3 lakhs rupees. The issue is that whether it is taxable. If it is taxable as income from other sources, and or is it taxable as capital gains? A decision of the tribunal is there, wherein a view has been taken that it is a windfall and it would be treated as an income from other sources. The reason given is that landlord has not transferred anything, he is just a confirming party. And the deed was otherwise, in the deed he was treated as referred to as a confirming party. In these short facts, a view has been taken by this tribunal decision in Chapia HUF's case that it is taxable as income from other sources. I would believe that other view also should be equally possible. In that earlier decision which I referred to, that Maharana Chintamani's decision, the Supreme Court very clearly stated that nomenclature is not relevant. Whether you call a receipt a rent or a capital receipt is not important. What is the fact behind the transaction? What is the truth of the transaction? Now, irrespective of the fact that whether I have been labeled as a confirming party, my question would be that could an outgoing tenant ever have transferred something without my consent? The answer is no. Under Maharashtra Rent Act, it is not possible. Now, it is possible that that consent might have been given at the threshold when the tenancy was created. But the consideration which is flowing at the time when an event is happening, which is an event of transfer. So therefore, the consideration which I am receiving still is related to a consent which I have given for transferring this. And therefore, in order for a valid right that is being created in respect of an incoming tenant to enjoy the property, that is created only on account of my permission to grant or confirm the transaction of the outgoing tenant to an incoming tenant. And therefore, I would believe that Vinod Chapia HUF's case is perhaps not the last word. It perhaps otherwise also, I would not believe that it is a well-delivered decision. So please look into this Maharaja's decision. Last is again an interesting thing is on which also there is a serious dispute that whether J landlord can claim deduction under or exemption under section 54. If he has reinvested, he has transferred something. Now whether it is 54 or 54F, primarily it should be 54 because he is transferring an interest in residential house. And 54 covers such a case. It nowhere says that what is transferred should have been an absolute house. And if that is so, then in that view of the matter, 54 should be possible. But if I don't want to grumble about it, 54 is something subject to other conditions. 54F is a possible exemption as far as J is concerned. But as far as S is concerned, and as far as the other man R is concerned, one of them is outgoing, other one is incoming. As far as S, who is an outgoing person, is concerned, he has transferred tenancy rights in a residential house. Again, by virtue of the later series of decisions which have been of late delivered, holding that tenancy rights are rights in residential house when they are long-term rights which have been acquired for consideration, for which you have received the possession, then and wherein you have a right to transfer to, then those rights are akin to rights, acquisition of rights in residential premises, and persons who are acquiring residential premises in those cases, the benefit of section 54 or 54F is found to be given by the tribunals in such cases. So if that is so, S, who is an outgoing tenant, also can perhaps say that that I am entitled to benefit of section 54 itself. However, if that fails, 54F is something surely on which there is no dispute, because he is transferring something other than the residential premises, and therefore he should be entitled to, provided the tenancy which is transferred is a long-term tenancy. As far as R is concerned, an incoming tenant, there is a controversy. Some tribunals have taken a view that yes, that this what you are required to acquire is an absolute right in the residential premises. For the benefit of 54, you should purchase the residential premises, not acquire a right in residential premises. And by virtue of that, you are not entitled. As against that, there are a couple of decisions which have taken a view that yes, that this is nothing but acquisition of residential house, and by virtue of that, you should be entitled to. You can take your own call. There is a conflict, and if the stakes are high, you need to examine the ratio of these decisions before you decide to advise your client. Thank you.
Question 13. On capital gain arising out of sale of shares, whether can assessee has to invest in his own name, or can he invest in the name of son or daughter? For that is the whole issue. Here one Bombay High Court judgment is cited.
See, whether it is 54 or 54EC or 54F, the common thread which runs through all these sections is that the assessee who makes the capital gain, that is the person who is the transferor, he should acquire the new asset or he should purchase the new asset. Now therefore, but at the same time there is no specific requirement that the new asset should be purchased exclusively or only in his name. There are two direct High Court judgments, the Madras High Court and the Punjab High Court, which have laid down that what is really material is who has provided the purchase consideration in respect of the new asset. So if the person who has provided the purchase consideration is the transferor, then these two High Court judgments say, then it is perfectly alright if along with his name, the names of his son, daughter or other relative are also included as the names of the transferees in whose name the new asset is purchased. And there is also a very interesting reference made to section 45 of the Transfer of Property Act, which says that if consideration is provided by A and the property is purchased in the name of B, then A can still claim title on the footing that he has provided the purchase consideration. But all these general principles and the judgments of these two high courts must be appreciated a little carefully, keeping in mind the provisions of the Benami Transactions Prohibition Act. Now, if the purchase is made exclusively in the name of another person, then it is arguable under the Benami Transactions Prohibition Act that there is an advancement, that is a gift made by the person concerned, who is the transferor, to the person in whose name the new asset is being acquired. In which event, it may give an opportunity to the revenue to say that the new asset is really being acquired by that other person who is your relative, and it is not really being acquired by you, who is the transferor and to whom the capital gain has accrued. So I would think, and the legal position is not 100% clear, but having regard to this slightly murky situation and the muddy state of affairs, I would strongly recommend that whenever a new asset has to be purchased and which is being purchased in order to avail of the benefit of exemption from capital gains tax under any of these sections, it is better that the transferor puts his own name along with the names of his transferees. That I think out of abundant caution would be the wise and correct and prudent line to pursue.
Next question 14. X is a proprietor of manufacturing concern. Y is admitted as a partner. Y will bring enough capital. We have to see what are the implications in the hands of X, considering the extinguishment of his rights to the extent of 50%.
Now, I'm quite mystified by this question because it throws up many more questions than the answers which I have ready for it. For example, I don't know whether the state, when it initially allotted the land to Mr. X for the express purpose of setting up a manufacturing unit, whether it charged some salami or premium for the allotment of the land. Because only then Mr. X can really justifiably claim that he has incurred some identifiable item of cost for the acquisition of the right of allotment in respect of that land. Now that appears to me to be a little doubtful, because from my limited knowledge of these transactions, ordinarily the provisions would be that the state allots, or state or a state government undertaking, the Industrial Development Corporation of that particular state, would allot a plot in an industrial estate to a person subject to his giving an undertaking that he would set up an industrial unit within a finite and specific period of time, and if he does not, then the corporation has the right to terminate the allotment and to forfeit it, no questions asked, and to re-allot the plot to somebody else. Now, this seems to suppose that Mr. X incurred some cost for the allotment of the land. The next question which then arises is, when he admits a new partner, whether he gives the partner a right to claim in the event of dissolution of the firm or on his retirement, a right to claim an aliquot share in the value of the assets of the firm. Because you can easily admit a partner, especially in the context of an asset which you already have, for which you have not incurred a specific cost. You can just say that he would not be entitled to claim any share in the assets of the firm. He would only be entitled to a certain amount arising out of the profits actually made by the firm, in which event again, this problem would not arise. The third question which arises is, if you admit the partner, you must make a gain. And only then the question of capital gains tax really arises. So, is the new partner paying some amount, which is really essentially in the nature of a premium, for the purpose of being given a right to participate in the assets of the firm, including in particular the land which has been allotted by the state government entity or not. So I think one would have to take a comprehensive and holistic view of the matter after going deep into the facts and after getting answers to all these questions. I don't think there can be a blanket answer to question number 14 as framed.
Next question number 15 for Pradip bhai, conversion of preferentials into equity shares.
As far as this question is concerned, now it is not a valid question. The government or the finance minister was aware of your issue, so he has sought to resolve it by Finance Bill 2017. A comprehensive amendment is sought to be proposed, whereunder now a conversion of preference shares into equity shares would be saved from the definition of transfer by virtue of section 4710A. It's also provided that the cost of these shares, equity shares, would be the cost of preference shares. And the period of holding also would be the one which would be the period from when the preference shares were acquired. So therefore, it would now not be taxable. Conversion would not be taxable.
Yeah. Next question, 50C besides 54EC and 54F.
Here. Yes.
I think we can go with the principles, whether where in section 54EC, yes, is capital gain and their wording is net consideration.
Very well, yes. This so here, this is a case study or a query wherein the issue is that when you transfer an immovable property which is subjected to 50C provisions, the capital gains which arises to you in your hands on such transfer, should it be computed under section 48? By also importing the provisions of 50C, the answer is yes. Then why not? Because it is the mandate of 48(2) that you have to bring in the provisions of 50C. The next question which arises that for this is that if you were to reinvest such computed capital gain, should you really reinvest the actual capital gain, or should you reinvest the reconsidered capital gain by virtue of provisions of section 50C? To give you an example is that actual capital in a particular case on transfer of a land happens to be 1 crore of rupees. But the stamp duty value based computation happens to be 1.5 crores of rupees. If you were to acquire a house for the benefit of section 54F, in such circumstances, should you reinvest 1.50 crores or 1 crores? This is the focus of the issue. If you were to reinvest in bonds, should you reinvest let's reduce it to 50 lakhs of rupees and 35 lakhs of rupees. Should you reinvest 50 lakhs or 35 lakhs, which is the actual capital gains? If you were to reinvest in 54, should you reinvest 150 or 1? This, because all three could have different answers, 54 EC, 54F and 54. This is an issue which has in recent times has been examined by several tribunals and one High Court, Karnataka High Court also. The sum and substance of these decisions appear to be that there is a conflict, and the conflict is serious. On one side, a view has been taken, Jaipur in particular, Indore following it is, stating that in an event when a reinvestment is being made, you have to first give effect to the provisions of section 54 or 54F, particularly 54F, which is considered to be a code by itself. Independently, the first limb of section 45(1) provides that you have to give effect to, because it reads as subject to the provisions of section 54 etc. By taking a leaf from that, a clue from that, these tribunals hold that what is required to be reinvested for the benefit of 54 or 54F is the pure capital gain and not the fictional or a notional capital gain. As against that, the other view is that that 50C is a part of section 48. You have to first compute the capital gains before you apply the capital gains provisions to section 54, 54F and 54EC. As long as this reasoning is concerned, one tend to agree with this reason as far as the provisions of section 54 and 54EC are concerned, and perhaps not for 54F. Because if you would look carefully into 54.1 and 54EC1, and 54ED2, what is required to be reinvested is the amount of capital gain. And the disallowance is qua the quantum of capital gain. So when you compute the capital gain, you would have by that time given full effect to provisions of section 50C. Because in computing that, it is required to be given effect. However, when it comes to 54F, what is required to be reinvested is a net consideration. And net consideration has been carefully defined to mean a consideration which is a full value of consideration, which is a section 48 full value of consideration, without importing the provisions of 50C as reduced by any expenditure relating to the transfer, or acquisition. So that in such cases, there is a possibility, a good possibility of holding that in 54F situations, the other decisions will not hold good. But when it comes to 54 and 54EC, these decisions of Jaipur and Jaipur would, though they are in favor of the assessee, I would take a view that they may not be laying down the correct view. There is already a Bombay Tribunal decision which has taken a view in the context of 54EC that while applying provisions of 54EC, you will have to first give effect to section 50C. So there is a conflict. There is yet another beautiful conflict is relying on the computation provisions and the apparent consideration which is flowing to the assessee. The assessing officers, Revenue Department is taking a stand that if your consideration which you